Hey everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account. Today we'll be talking about the economic data that's newly released on Thursday, November 2nd. The U.S. Labor costs unexpectedly fell in the third quarter as labor productivity rose by the most since 2020, offset by rising hourly wages, which could mean less inflationary pressures. According to the report, the wage produced for a unit of product fell 0.8% at seasonally adjusted annualized rate after a 3.2% rise in the second quarter, the first decline since late 2022. By contrast, analysts are expecting a 0.7% rise, arguably as a surprise. Among them, hourly wages rose 3.9%, which was offset by a 4.7% increase in labor productivity, while the continued productivity surge was equally surprising, beating analysts' expectations of 4.3%, the biggest quarterly gains since the third quarter of 2020 and 3.6% in the second quarter. In addition, labor output grew 5.9%, the fastest since 2021. Working hours rose 1.1% in the third quarter after a decline in the previous quarter. Despite the volatile quarterly productivity figures, overall, the two consecutive quarters of productivity growth suggest that companies are stepping up their effort to improve efficiency. Despite high borrowing costs, corporate investments have remained stable, underpin long-term economic growth. At the same time, continued growth in labor productivity could help companies to offset price pressures from rising wages and other operating costs, which shows a positive sign for the U.S. economy to continue its rapid growth rate. Most of the U.S. macroeconomic data strengthened in the third quarter, with GDP growth at an annualized rate of 4.9%, mainly as consumer spending rose to the highest since 2021. Meanwhile, the Employment Cost Index, a measure of wages and benefits, continued to accelerate in the third quarter due to wage growth. While employment cost growth has slowed down from a year earlier, third quarter employment data have raised their questions about whether wage growth will continue to decline for a long time or not. The Fed said that the wage growth has slowed significantly over the past 18 months, roughly close to the need to maintain a 2% inflation rate, suggesting that a possible end to a rate hike. However, it also opened up possibilities for the Fed to continue raise interest rates, as it still need to examine the U.S. economy's adaptability to the high interest rate environment. Analysts say that the third quarter labor productivity and labor cost data provided further evidence of the broad deflation trend and should strengthen the Fed's judgment of a suspended rate hike this year. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.